All right, Ben, we just finished a session with Eugene Profis from Black Diamond Asset Management. Mind blown. To be
Yeah.
honest, it's one of those episodes where I just took a back seat and just watched two geniuses go at it. And you being one of them, that's pretty
Oh,
amazing.
wow.
Like,
Thank you.
call you
Thank
the
you.
genius. Just slid you right in there. That and I'm fighting a terrible cold, as you can hear by the nasally voice. So just sat back and produced the whole thing. Anyway,
Yeah.
give me your initial thoughts.
Yeah, so I'd say it was excellent. Eugene did a great job. He took lots of time going through his worldview, how he thinks about markets. I'd say before we talk about it, though, we do talk about a lot of stocks today. He mentioned a bunch of names, so anything you hear today is not investment advice. Certainly talk to your advisor. But if you're interested in hearing about a global look on, different sectors and areas that look super attractive, Eugene goes through it in detail. And one of the things we've kind of been talking about in our dailies and weeklies is you get kind of this massive divergence. You get tech and S&P kind of touching all-time highs. And Eugene mentioned a bunch of stocks today that are down, 50, 60, 70% from their highs. Super great businesses. And a lot of them you wouldn't have heard of before, that are trading at extremely attractive valuations. And so that was really super interesting for me because oftentimes people say, well, how can you do anything else besides the index? Well, he gave us great examples of why you want to look around the world and see some outstanding companies that there are out there to buy that don't look like the Nasdaq.
Yeah, that was probably the biggest takeaway for me as well. I mean, but you guys got into it. You talked about Alibaba and what really happened to Jack Ma, and he actually reveals where Jack Ma really is. Unbelievable.
It's
So
true. That
we got
was
to watch
awesome.
through. I'm not even gonna tell you where it is in there. You got to watch the whole
Yeah.
thing, and
Yeah.
it's exciting.
And he does. He talks about what happened to Jack Ma and just kind of the changes that have been happening at Alibaba,
Yeah,
what happened around Ant Financial, which was their tech company that the Chinese government squashed. So super, interesting. It'd certainly say watch that if you want to know what happened to the guy. That was cool. But I think from a where does this fit portfolio construction perspective, Eugene said it pretty well, saying, this is a compliment. He left some big firms running multi-billion dollars to start his own firm about a year and a half ago because he was looking for ways to add value and complement, something that doesn't look like the index. How can you put his portfolio next to the S&P and it actually results in a smoother ride with better returns? That was one of the things that I thought was interesting is, he's made this change to try to do something unique and different and really kind of complement what's happening in the new investment world.
for sure. Well, without further ado, here's our interview.
Hello, everybody. It's podcast number, which one? What are we on now, Scott? Number 37 and
Yeah,
a
we'll
half?
call it that. If not, we'll change it afterwards.
Sounds good. Well, we're excited tonight to have Eugene Profis in from Black Diamond Asset Management. Eugene and I have had some great conversations, and we're here to talk about a little bit about his career, how he got to where he is, but then we're going to talk about global equities and investment management, and certainly excited to hear about some of the things that Eugene's working on. He's got a very interesting distressed fund that I'm hoping we can dive into some of that today as well. So, Eugene, welcome to the Think at Heart. We're excited to have you on and excited to hear what you have to say for us today. And Scott, was there anything you want to add to that?
No, I think we should jump right into it.
Perfect. Eugene, maybe you can tell the audience a little bit about yourself, The first things that I typically like to know is, why'd you get interested in investing, and maybe tell me a little bit about your story. And feel free to go back as far as you want. I bought my first stocks at 13, but everyone has their own career path. So maybe tell me a little bit about how you got into the business.
Sure, and it's great to be here with you, Ben, Scott, and everyone else. Appreciate the opportunity to tell our story. My background, owned my first stocks at 13 years old. Got interested very early in the stock market. Started with the basics, reading John Train's Money Masters and Intelligent Investor, Ben Graham, the classics. That kind of gave me a pathway into what I was looking at.
Right.
I won a couple of stock market challenges, and this was probably around 2000, simpatico license. Actually, at that time, I won a car, sold a car.
Nice.
And invested some of the money, but did go to Europe and enjoy a lot of it. So that was kind of, that was a lot of fun. My background, prior to starting Black Diamond Asset Management, I was at a company called Burgundy Asset Management, and later I was at Mackenzie Investments. I started my career in investment banking. After university, I knew what I wanted to do. I knew the path I wanted to pursue, and I had met some people at Burgundy who were very insightful and really led me down to the path. These are some of the smartest people I've ever met. And I said, well, I want to do more of that. And I very quickly realized that the ultimate reward in investing is not actually money, it's knowledge. Because what I've done the last 20 years is I've flown all around the world and learned about leaders of industry, different cultures, and how these businesses are different here and how they're different there. Because our philosophy has always been that great business models have been transported globally. A lot of people went to school out west and gone back to their home countries and adopted these models locally. So that's kind of how my career started and where I am today.
Nice. So as investment banking, what they say, like you work 75 hours a day and you never sleep, and is that how it is? Is that really how it is?
It's a bit worse than that. But there isn't a lot of gratitude for being an investment banker. The work's pretty monotonous after a while, and you're really not learning a lot. Whereas something like investment management, when you're learning different business models, doing factory tours, it's really understanding how everything works. If you like to understand and to get into the details of something, then it's a very very fulfilling career path.
So once you shift from investment banking, what's the first kind of place you actually get to make decisions, or you get to be involved in the decision-making process? That's with Burgundy. What's kind of the first book you're on?
Yeah, it was part of the global fund, and we were in the U.S. portfolio at the time, and contributed to what we called at the time the Globex mandate, and that was 2008. I started basically the week after Bear Stearns collapsed.
Nice.
So it was a very interesting time to get into investing. Happy to say I'm still sitting here because at that time we didn't know how things would work out.
A lot of people moved on from the business after that, for sure.
That's right.
For sure. So when you start to, you start with your kind of your base fundamentals of looking bottom up. You referenced Benjamin Graham and some others, and as the kind of the world evolves and you start learning the business a bit, how many kind of face-to-faces would you have with CEOs and things each year? Would you be like when you started? Was it quite frequently? Maybe tell me a little bit about who you met, or if you can, or where you went. Be interesting for people.
Yeah, I mean, the best way to meet CEOs are, at a conference where they are looking forward to meeting and addressing the concerns of investors and trying to understand who's supporting them.
Yep.
And then from then you try to build a relationship and you try to see them on their own turf. So when you are in their home city, they will go out of their way to host you. Mm-hmm. We typically do, I would say, close to 300 management meetings a year.
Wow.
I mean, if you think about it, it's not that, it sounds like a lot, but you can do 40 in a week at a conference. So, a large conference, not every conference is large. It was actually, one of the best industry conferences, which is really accessible to almost anyone. It's called CAGNY. It's down. It's put on by the Consumer Analysts Group of New York, and I have met every single consumer product CEO in the last 20 years, whether it's Muhtar Kent from Coca-Cola or Indranui. Everyone is there and very willing to share their opinions. I've met Warren Buffett. I've met Jack Ma. Mm-hmm. These are Jack Dorsey. These guys are leaders of industries, titans.
Yep.
And it's interesting. Like, you don't get by strictly seeing them on TV or getting an idea about. You don't get exactly how smart these people are, how intense they are.
Sure.
I saw. I met with Jack in Hangzhou, China, and Guangzhou, sorry. And he's one of the most intense human beings you will ever meet in your life.
Yeah. So
his recent problems with the Chinese government sure don't surprise me. We've been following Jack for a very long time.
Yeah. No, Alibaba is just going to be certainly. At some point in the distant future, maybe that'll be unpacked and we'll find out what's all happened there and to him and to the whole company. But certainly we see a nice rally out of Baba today, and some of the names you own I know have rallied pretty hard today. So I'll be interested to talk about those. But it is a difference maker when you can sit with them and talk with them and see and learn what they're thinking about from their business. Are they usually pretty open and kind of discussing what they're thinking about, what's happening, where they're going?
Yeah, if they get a sense that you have really taken an interest in their company, mm-hmm. and they understand that you have taken the time to learn about the business, they will for sure be open with you. They're not going to give you financial projections.
Sure, of course.
But they want to educate you on how everything works. So, it's like anything. There are no stupid questions in this business, because if you have someone who's really intelligent answering them, you will learn a lot from them. And and that's the business. It's all about asking questions.
Right.
So it's really important that you try to prepare before you do anything with management.
Yeah. So you met Jack Ma, and Jack Dorsey obviously has stepped down from Twitter very recently here. Were you surprised with that decision?
No, I'm not really surprised. I was surprised he ran two large companies for as long as he had. I think, like you said, I don't think Twitter needs him anymore. It's a media platform. There's he's focused on what he believes is the next iteration of cryptocurrency and blockchain with Square. That's also the much bigger business at this point. So, it's not at all surprising that
Yep.
he's stepped in.
Yeah. So maybe tell me a little bit about how your philosophy presently looks, and maybe walk me through how you got to it, because, as you mentioned, you started valuations. Valuations, I think, is probably still part of your thought process, but maybe tell me a little bit about how it's changed and maybe what it looks like today. And I'd be interested in talking a bit more about that.
Yeah, so it's interesting when you start in this business. It's you think your primary goal is to figure out how to make money, and that leads you down some very bad rabbit holes. And the issue with that is there's no shortage of ways to lose money in this industry. That's why what we do is we really focus on quality and fundamentals. So we want to hold businesses with two fundamental pillars that are predictable, have predictable economics, so we can have a chance of modeling them correctly in the future, and then have high returns. Now, the only way you're going to get those two pillars together is if you have a sustainable competitive advantage, a moat. These are the sources of these moats are typically, network effects, like a Visa or MasterCard, brands, special licenses, intellectual property protection. That's what really allows us to get those quality metrics that we're looking for. Now, our philosophy is we don't want to own everything.
Right.
We know what we want to own. We're looking for those few businesses that operate at the top of their value chain. So, we're looking to identify them, to study them, to value them. And then these are great businesses. So more often than not, they're expensive. So we wait.
Yeah.
We wait until the market dislocates.
Right.
The example I kind of always use is if you think of a company like Nike. Nike spends 10% of the industry's capital and they make half of the profits. Okay, the rest of the industry, which are the retailers and manufacturers, they spend 90% of the capital,
right,
and they make 50% of the profits. So Nike sits at the top of the value chain of their industry.
Yeah.
And we want to own the Nike of every industry, right?
Okay.
We think it's important to have a diversified portfolios, but there are some businesses we don't want to own because when I mentioned the fundamental pillars, predictability, they're either changing too fast or they're getting disrupted, or they're too capital intensive, which drives down returns. And when I say high returns on invested capital is one of our pillars, we're looking something higher than 15%. That means give me $100, I'm going to give you $15 for the rest of your life. That's how we think about owning high return businesses. Nike's certainly one of them. However, Nike's not always inexpensive enough to own, but it will be. Again, it has been and it will be again, right? It has many international businesses.
Sure.
It'll fall out with somebody, probably with China in the next not too different future, which is a very large business for them.
Sure.
So, there's no shortage of opportunities in the market.
Yeah. Yeah, so it's a good example, and I mean that's a global integrated company. So, like, how has this kind of last 2 years played out for a company like Nike? Has their business adjusted, changed as a result of things? Is it better? Is it worse?
Yeah, I mean Nike has been a tremendous outperformer, and they've done incredibly well in the last 2 years. Basically, if you've been to a Foot Locker store, which is their primary distributor, I should say brick and mortar distributor in North America, they have a big direct business now as well. Nikes are constantly sold out, right? There's Adidas, there always has been, there always will be Adidas. But it is not the category champion, and we will always pay more for the category champion because those are the companies that are true compounders and outperformers over the long term.
Yeah. Yeah, so I mean, this is a good company, obviously, to mention. And there's lots of things kind of happening in the world too, from an investment perspective. Does ESG start to come in every conversation when you're talking about companies? Like, would that be something that comes into your investment decision, or is that something they talk about, or is that kind of not super part of the process?
It is becoming more part of the process. I think it's important, and it's important to our investors and to people. So it's important to us. ESG means a lot of different things. We don't typically own any oil companies, any banks, any tobacco companies, any airlines or cruise ships. Those are just quality metrics.
Yeah.
Now, tobacco companies are very high quality from a financial perspective.
Yeah.
But again, we don't own any of them. We have our own ways to get exposure to two factors. We don't need to own tobacco businesses. So
Yeah.
yes, it is important to us, and we are looking to do more there as well. We see a lot of ESG funds out there that have Exxon and Chevron as, their top holdings,
Yeah.
and for us, that's not really how we think about ESG.
Yeah.
Logging companies are another one that are interesting to us as well. But that if I'm going to call something ESG,
Yeah.
maybe planting more trees than you cut down.
Sure.
But certainly, we think of maybe sustainable versus straight
Right.
ESG, which every company at this point, I've seen them all in ESG funds.
Yeah, yeah, for sure. I mean, you look at the Canadian Jancy Social Index, it's banks and energy are the top 10 companies.
Yeah.
Yeah, so fair enough. So you look at everything, you look globally, you're not limited to anything that you can buy. Is that correct?
That's correct. As long as the companies have adequate liquidity,
Yeah.
we'll look all over the world. We have, again, like you mentioned, we have a couple portfolios. One being a distressed portfolio, and we've seen a lot of disruption globally this year. China has really been an impediment to emerging market flows.
Yeah.
But then you have Brazil, and you have an election next year that's really scaring people, and Brazil is really falling apart. So, we're seeing, while the U.S. large caps are at all-time highs, we're seeing some of these companies absolutely at near all-time lows.
Yeah.
So, we kind of think of how could we create portfolios to complement what people do, even though, when everything is working on their cores, this may not.
Yeah, no, that's fair. So what do you make? I mean, I kind of had the thinking that we'd reach kind of peak globalization around Trump getting in as president. And now we've seen, like you say, the U.S. has outperformed everywhere for the last, well, probably 10 years, and maybe longer. What do you make of this kind of massive dislocation?
Yeah, so I think there's a very simple explanation, and it's not as it's the U.S. has outperformed because they have the best intellectual property rights in the world, and thereby have the best and really only technology companies that worth paying attention to.
Right.
China had a few giants in Tencent and Alibaba, which were probably top 10 at some point, even top 5 potentially with one of them. But they've chosen to go another direction. That was surprising to us because China always wants to have a category champion or a global leader.
Yeah.
And the fact that they're doing this to their best companies was a surprise to us, because now it's going to be very, very difficult for them to catch up.
Yeah.
at the beginning of the decade, we were actually very optimistic that for the first time we saw China move from the copycat economy to innovation.
Sure.
And like when we went in 2011, they really weren't innovating. But we went to Baidu. Baidu was just a copycat of Google,
Sure.
and Google was kicked out, so they had a monopoly presence. But then when we went to Alibaba a few years later, that changed everything for us because those businesses were innovating, and that made us very optimistic on China. But we've been really close to the Alibaba story for a long time. We owned them through Yahoo since 11. And we actually do know what happened with Jack Ma. It was, no, I mean, not recently, his disappearance, but how he fit in with the current regime's policy. He's in Spain, by the way, if anyone's curious. Even within the Communist Party at the leadership level, there's competition. And Jack Ma was very closely aligned with Xi Jinping's competition.
Okay.
And that's why, Ant Financial, which was owned by his competition under Jack Ma kind of watch, was put to bed or extinguished.
Okay.
Right, because it was $300 billion that he did not want to use used against him.
Yeah, of course. Yeah. It's he bet on the wrong horse, is what you're saying. So to speak. So to speak. I got my dogs making themselves known here. They like to get into the show every once in a while. Sorry. Hey, we're gonna have to edit this section out here. Usually they keep it under control. So obviously you're surprised by the changes out of China. I think it probably caught a lot of people off guard, and I guess I'm wondering, China's always been thinking kind of the long game. Do you think this is a temporary reprieve? This is part of retrenching, maybe realizing they're a little overextended in certain areas, so they're, I guess, trying to rein in power. Any thoughts around that?
Yeah, I think, China continues to kind of be built on 5-year plans, and they have the meeting of the Congress next year. So, I don't think this will be really any different. If you think about the policies that were put forward, they're very popular with people, right? Cheaper education, lower cost housing, reforms, taxes on the wealthy. These are all things that are supported in a communist regime because not everyone is wealthy. So the people are actually supporting these policies. Now, you also need to make sure that the people have somewhere to go and work at the end of all this, because this plan was supposed to be around services and innovation and technology, and you can't really do that if you destroy the technology sector.
Right.
You haven't yet, but you've certainly destroyed a lot of capital.
Yeah.
So it's going to be harder to turn around from this. This is certainly worse than anti-corruption in 2016.
Yeah.
But again, at the same time, we've seen not exactly this. We've seen China turn around pretty quickly, and overnight China eased monetary policy.
Yeah, saw that.
They're not going to ease monetary policy and then continue their assault on businesses right now, because it just defeats what they're doing.
Sure.
And last time they eased 6 times, and it wasn't as effective as they wanted.
Right.
So I think they're getting they're getting very close to the end of it. I think they were very surprised by the move in their companies post Didi,
Right.
the delisting. They thought it was an isolated situation, and then
Right.
everything was down tremendously on that news.
Yeah.
Again, I think at this point it would be prudent if the companies are dual listed, like a Alibaba,
Sure.
or NetEase, to own the Hong Kong listed shares.
Yeah.
So there aren't any capital flow disruptions.
Yeah. Makes sense. So just probably for the listeners, just what they did with Didi is they essentially forced them to exit the listing in New York, right?
That's right.
Yeah.
So they again, if you are going to do a large overseas listing, you need to get the blessing of the Chinese government.
Yep.
The Chinese government told Didi not to list. They listed anyways.
Right.
And then you saw them say right away, "We asked you not to list."
Right.
Stock didn't hold up for very long.
No.
Didi's the Chinese Uber,
Right.
essentially, so when finally Didi gave up and said, "Okay,
Yeah.
we're going to delist after 5 months on the exchange."
Yeah.
So that was not very favorably received in a time where everyone's looking for one last excuse to sell their Chinese names.
Yeah, exactly. Yeah, I was looking. I write a daily newsletter to clients, and I said today, like, I think maybe we saw the bottom of KWeb and FXI. It looks like we may have at least seen the near term bottom on those names, eh?
It's possible. Tomorrow is another day. I think, I think there's a lot going on right now. I think, we were more hopeful for the Olympics, and where we worry now is the Omicron outbreak, because China has a zero COVID policy. That means they lock down everything as soon as they get an outbreak. If they have the Olympics the way they are intended, it would be be a very low likelihood that the new strain doesn't spread there.
Sure. Yeah.
And that would be difficult for anyone. I think this diplomatic boycott that they're talking about in the U.S., I think is going to happen because I don't know if anyone's going to be allowed in.
Right.
So they're preempting it potentially.
Right.
But they're risking severe unrest right now by locking down potentially to this new variant. So they've backed themselves into a corner, and there's not much left for them to do.
Yeah, COVID seems to be continue to having major impacts everywhere. So what's your, kind of as an aside note, what's your take on kind of these concentration camps in Australia with these COVID? Like, if you're suspected to have COVID, you have to go to these camps. If you question whether you're doing
that's
any
probably
comments?
a question I won't be answering.
Won't be answering that one.
That's a different philosophical question. I don't want to be getting any hate messages from anyone, depending on their view towards.
Fair enough. So we'll switch gears. I'll leave that. I'll save my own comments on that for another day. So when you're constructing portfolios, obviously you talk a lot about the businesses, you think about them, you look at where they are, find the best ones. Does what's happening in the economy or cycles play into that, or how do you think about the economy around it?
It does, in the way it impacts valuations. We want to own our core positions for a very long time. Mm-hmm. But at the same time, we have to be conscious when too much goes your way or against you at any given time, because this is a psychological market. I think what we saw last week was it definitely should cause people to pause and think where we are, because China will sort itself out for better or for worse, but the Fed turning hawkish was not something we expected in the face of the new variant.
Right.
And so far, the market's really not not paying any attention to it, and people don't want to sell and take gains at the end of the year.
Sure.
That worries us a little bit.
Yeah.
We do remember 2018, those nasty couple of weeks. But at the same time, a hawkish Fed, it could be nothing, but it does worry us a little bit, and we're seeing some movements in the credit markets that we're paying attention to that we haven't seen in a very, very long time.
Yeah.
So far, there's nothing, but certainly if we started seeing more distress, and we're not expecting any kind of Ukrainian invasion tomorrow, but if there's certainly headline risk with the two presidents talking tomorrow.
Yeah, no, fair enough. So I think about it. I think you're right. I mean, credit spreads still look reasonable. They did go out and they came back in a bit last week. So what would you do if you get more signals that say, okay, maybe the economy's slowing, the Fed's hawkish, we're getting these multiple inputs, bond yields flattening, all these things telling you that maybe the economy's slowing. So what would you do from a portfolio perspective?
In your particular scenario, with an economy slowing, I think rates would back up pretty quickly. I think you'd still see the same leaders as you saw previously, the large cap tech companies.
Okay.
But we typically have portfolio insurance on all portfolios at all times, and we do now. Especially, we have for most of the year. It's hurt performance a little bit, but. After the runs we have had in just about everything, we think it's important to err on the side of caution here a little bit. We do believe that we're still in the process of resetting the monetary base, and the Federal Reserve cannot say that. But if you compare them to valuations in other places where this has been done, like Japan, valuations are still extremely inexpensive.
Right.
And they don't really get expensive at this rate until, 6-7 years out, which puts us in line with a nasty correction every 20 years. So that's kind of how we view it.
Yeah.
That doesn't mean that there aren't cycles when Fed raises rates.
Sure. Yeah.
Which we haven't seen that in a while.
They'll try. Maybe they'll talk about it.
Exactly.
Yeah.
Exactly.
Yeah.
But they do need at this point they might have to do it, and it's not for inflation's sakes. It's just in case something else happens where they need to restock their bullets.
Right.
Right. If they're sitting here and still buying 120 billion a month, if they start increasing that number because of something else, another world event, buying 500 billion a month, I'm not so sure the markets would really appreciate that.
You get
short, intermediate, or long term.
You get crypto at $1 million before you know it. Bitcoin goes to $1 million.
Yeah.
So, just to clarify though, for people on you buy insurance, so that's you're talking about buying puts to protect the portfolio.
Yeah, buying market puts to protect the portfolio. We use derivatives, for protection against market risk or any binary risk we may see in one of our names.
Okay. Yeah. So that, like to your point, in an up year that adds drag, but in a down year that gives you huge protection. That must have helped a lot last year.
Yes. Yes, it would.
Yeah. So maybe you can tell me a little bit about the distressed portfolio. I think this is something extremely unique. It's something that I haven't seen anywhere else. And maybe tell me a little bit why you thought of the concept, and then talk about how you think about it, because it'd be much different than a global large cap portfolio, much different strategy and philosophy. So maybe you can tell me a little bit about that.
Yeah, so when we were sitting and COVID occurred in March 2020, we said, well, yeah, the best companies in the world, they probably have 50% upside, maybe 60. But some of these distressed names that are still good businesses that we have followed for a very long time have 500% upside. And the reason of that upside is because their industries went to zero overnight. Anything travel and leisure related, consumer finance companies in some regards. Like if you had a concession in an airport, right? Yeah. These businesses literally went to zero and the stocks were down 95%. Now, understanding that, we'd probably get a solution to COVID. We'd probably get a vaccine at some point. These industries would rebound. So we created a portfolio that's really focused on macro or micro disruption. The way the fund is very global. It's 75% outside of North America. It's structured this way because North America has a very developed public bond market. That means companies get capital. They borrow money in the form of debt from bond holders, which could be private equity, could be institutions, could be individual investors. In Europe and other parts of the world, that credit is given to them by the banks. And the banks, they certainly don't want to run your business for you. They don't want to take any write-downs. So you have a lot longer to solve your problems that arise from debt than you do in North America. That's why the fund is very global.
Got it.
Again, we don't own any. You'd think distress. Well, yeah, oil was distressed.
Right.
Banks were distressed.
Right.
We don't own any banks. We don't own any oil companies or energy companies.
Yeah.
Even though we're very familiar with that industry. I'm originally from Calgary, so have worked in the patch before.
Yeah.
And then no airlines or cruise ships. Those airlines we don't believe are very good businesses. They have very mobile assets. There's not a lot of sustainability there. And cruise ships, they're very large pieces of floating metal. Now, again, cruise ships would be the closest we own to any of them because there's only 3 of them, and nobody wants to take over your cruise ship, because you can sell it for scrap metal if you cease to operate. But we really focus on quality businesses, whether it's consumer discretionary or industrials, technology, even infrastructure assets, in particular, like airports in a time like this, would be interesting. Would be interesting to us. If we don't own the airlines, we can certainly own the airports. We own a few of those. But again, it is a very different mandate. It skews smaller because that's where you see the majority of distressed businesses. And we found that it's a very different portfolio. It is more volatile, but it is very, very complementary to a large cap core portfolio like you would see in a lot of developed markets.
Yeah, I think there'd be probably tons of unique opportunities. And as I look across, and I just kind of recently did a screen to see how different stocks have performed this year. And as you note, kind of indices are bouncing around all-time highs. Yet some of these, there's stocks down still 70-75% from their highs.
That's right.
Yeah. So your expectation, as you mentioned, are like 5x on some of these names. Is that how you think about it?
Well, at the time, certainly in March 2020, there were some of those have rebounded. But we are, again, every year, particularly during tax loss season. I mean, we're seeing a lot of these companies that are down, 70 to 85%. And these are good businesses. These are businesses that people couldn't get enough of in April. And now have been thrown away. It's really incredible to us, but it happens every single year. Outside of the large, tech businesses, they get $1 every flows into core markets. These businesses are, provide some tremendous opportunity. And certainly, once tax loss season is over in the next couple of weeks, some of that selling pressure would be alleviated.
Yeah, I would think as well. I think there's a lot of opportunities there. Any thoughts around tech? Because I know you follow tech very closely, you know the names very well. You know, recently thinking, and you've been in the business a similar time as I have. You know, those first kind of 10 years in the business were nothing for tech, right? You didn't make money. If you bought the Nasdaq in March 2000, you didn't make money for 10, 11 years. And since then, the Nasdaq's gone straight up for 10, 11 years. Any comments, any feedback or thoughts around how that's evolved?
Yeah, I think tech is the most important sector in the S&P 500. It is I mean, probably the most important sector to the global economy. And technology businesses, they have found a way to earn a disproportionate amount of capital, of profits, while deploying a reasonable amount of capital, but still really sitting at the top of their value chains. And that's what that's why we like tech so much, because they become global platforms, essentially toll roads on economic activity.
Right.
And we want to own those businesses. This is why we liked Alibaba so much. Because it was, essentially it was a 2% tax on the Chinese consumer on everything they bought.
Right.
We have a $6 trillion spending from the Chinese consumer. Alibaba essentially makes $120 billion as 2% tax on everything. That's a great business.
Right.
And they may do a lot of other things and make a lot of noise, but simplicity. They make 2%. Which is a fantastic business.
Sure.
Right. Right now we're very positive on Mercado Libre, which is the Amazon of Latin America. Again, Lula coming back, he is socialist, let's say, put mildly. But that doesn't change the fact that Mercado Libre is down 50%. It's got growth rates that are 75% plus right now, and COVID has essentially solidified them as the winner in Latin America. We think global platforms like that are certainly something that we should be focused on.
Yes, so I guess kind of two questions with that come as I think about that. One is, if you invest in a Brazilian company, you buy that in Brazil, and what do you do to the currency? And the second one,
actually, the top companies in Brazil, Mercado Libre was it's a $55 billion company. It was as high as $100 billion. It's listed as an ADR in on the Nasdaq. Now it's not even listed in Brazil actually, because it's an Argentinian company. It just dominates. Brazil is the largest market, and that's where it dominates.
Got it.
So it's not. It's not listed there.
So I would agree with you. I think we'd agree that technology, I think, is certainly going to continue to take more of its share than it necessarily justifies or puts in, and that would be, I guess, inherently deflationary in the world. Any thoughts around that, where you think about how that continues to put pressure on kind of this world that we live in?
Yeah, I mean, we just got rid of the transitory term, so we're going to rush off of that. But I think my stance on inflation has been pretty constant. It's really difficult for people to understand because it hits them and it hits their pockets immediately. So you can't talk to somebody, you can't talk to an investor and tell them, hey, don't worry about it. It's not a problem.
Right.
You're paying 40% more for food. You're paying 60% more for energy. It's not a nice place to sit and talk about right now. So we kind of have to break it down one by one and individually on where the inflation pressures are happening. I think if you get the Fed chair in his testimony last week said, listen, If the variant's bad, we're going to have more supply chain disruption, which is causing essentially 100% of inflation right now.
Sure.
It's not. It's not the scarcity of goods. It's the scarcity of getting goods.
Right.
That's the issue right now, and we're all living with it. You know, I don't have a time frame for when this is going to be sorted, but I do believe it will be, because like we have seen essentially deflation in the last 10 years. Now, part of that was the great financial crisis,
Sure.
and that destruction of capital we've been working back from for a long time.
Yeah.
It just means, you know, there was too much debt and we have to reset the monetary base, which, you know, if you want to talk about it, we can talk about the mechanisms that the Fed are using to do that. But at the same time, you know, if you think about food, you know, you and I aren't necessarily 40% hungrier this year, and there isn't 40% less arable land. So, you know, something, you know, we can attribute it to what it is, which is the supply chain disruption. Energy, I mean, you guys remember that we were washed in oil. Oil was negative $20 not very long ago, right? There was a reason for that. So we're not, you know, we live in Canada. We understand we're perpetual energy bulls. And, you know, I spent the weekend in Calgary and Edmonton last week. And, you know, everyone's very excited and they think, well, it's going to $200. But I remind them that, listen, you know, this is an industry that's very close to my heart, even though I don't live in Alberta anymore. And, you know, we've done a lot of work on the technical reserves in the United States, and there's so much oil and there's so much gas. Just, you know, I have to remind them that, you know, if oil goes to $120 this year because of short-term supply disruptions, it's going to be negative 20 again.
Save some money.
You know, people are, you know, the oil industry is inherently greedy. They overinvest at the peak of the market and flood the world with oil. And there is a tremendous amount of reserves in the Permian. And they have the infrastructure to get it out. And if they don't, and if oil does go higher, well, you know, the next Republican or the previous Republican president will absolutely send oil back to where it was previously. Remember, no president has really survived a spike in the gasoline price at the pump. So we're conscious of that, and we've seen this playbook before.
Yeah. I think we may have peaked in oil. At least I think we're starting to see the direction soften in some of the commodities, anyways, with energy being one of them.
Yeah, I think, you know, I think it's we're not making that call. You know, it's still in deficit right now. So in the short term, it's very difficult for us to say one way or another. We just know, you know, what the reserves and how to get them out, right? You know, these pads have been installed and are ready to go if we need them.
Yeah. Well, I think that's been great. I wouldn't mind to hear a little bit about kind of portfolio construction, like how it would look, you know, how you would construct the portfolio, and then and maybe talk a little bit about how you think about that, how you think about maybe, are you fully invested? Do you raise cash, or do you just use the puts for protection? Maybe a little bit portfolio construction, and then I got a few final questions after that.
Yeah, exactly. So we don't have any cash typically. We always find that some of our safer positions, some of our higher quality names, even in the distressed portfolio, are acting well. If we ever do need cash, we use puts for market protection, so they can be their own sources of cash. when the market declines, right? As they become a larger part of the portfolio relative to the equities in that case. So that actually works as a great rebalancing tool. We run very concentrated portfolios. So, particularly in distress, 25 to 45 names. We're 35 right now. And again, this is where, because we're seeing a lot of opportunities. Like if you remember in April, there were no emerging market opportunities. China was at all-time highs. This is, 7 months later, everything has changed. But we're sitting there in April with travel and leisure companies, and we, everything had gone up so much. But we had quite a turnaround since then. And now we have a whole host of other opportunities, as we talked about in Europe and emerging markets. And certainly with this new variant, a lot of these travel and leisure companies are below where they were a year ago. So, even though we're feeling more comfortable with the virus, people are getting pretty tired of their daily disruption.
Yeah, that's true. Very true. Yeah, no, that's fair. So I think I got two kind of final questions, and then certainly if you want to add anything else at the end, certainly that'd be great as well. And I guess the first one would be, is there anything, any sector or area or country that's getting the most attention for you these days that you're most keenly trying to learn and understand about?
Listen, we have our dream team list, and certainly where we're seeing the most opportunities right now is emerging markets, because we understand that the flows are very cyclical. It's all flow driven, so we want to make sure that when flows revert or correct here, we're positioned properly, because all the tide will rise all boats, right? So we think emerging markets is certainly one. Travel and leisure, it's right back. Like European consumer discretionary, we're talking about a company like duty-free stores, Dufry, right? This was a 200 euro stock. Went to 20, it's still at 40, right? And it trades at 3.5 times EBITDA. So these are businesses that we're surely confident are going to be leaders in tomorrow's world. And this isn't just a retailer. Their value is in their licenses in airports. They have presence in all major airports in the world, and they merged with the Benetton family's World Duty Free stores a couple of years ago to create the number one leader. And funny enough, Alibaba bought a stake in them recently. Via rights issue. So those businesses have some very strong backers, leadership positions, and are trading below where they were a year ago. So, those are the kind of opportunities that we're looking for. It's really a lot of distress opportunities, because if you've been following the market since October, even large cap tech has done very well, but everything else is has not. So this is why we're, opportunity is plentiful right now.
Yeah, fair enough. So the last question I have is, like, what's something that I should be asking you? Is there something that we missed? Is there something that would help viewers kind of understand a little bit more about the process? Is there something that I should be asking you?
Yeah, so the main thing to understand about what we do is, we're building tools. It's on its own. Our products are not right for every portfolio, but if you understand the risks you are taking without kind of analyzing them or quantitating your risk, our portfolios are very complementary to what investors are investing in on their own, which is, we've kind of demonstrated that that we're doing something that's very different from what they would currently own.
Fair enough. And the last one that just popped into my mind, sorry, and I know I already said it was the last one, but going off and to start your own asset management business, what drove you to do that? What was the deciding factor that got you to make the decision?
Well, it was March 2020 when I decided to leave, but it was really kind of what I've been alluding to. I believe the industry is changing. A lot of the businesses, a lot of the companies that I used to work for are all doing the same thing, and there's being less and less value added by active money management. Where I thought, listen, I want to build tools that are complementary to what people do. So, do things differently. So everything we do is different. And it starts even from the makeup of our team, and we have a huge quantitative presence from our analysts as well, which is very different than what you'll see at companies that I used
shops.
to work with.
Yeah.
Yeah.
Well, listen, awesome. Congratulations for taking the step. That's awesome, impressive, and I really thank you for spending this time with us. You've been very patient and answering our questions. Scott, was there anything that popped up that you thought about as we went through there?
There's a lot of info in there. I think the best thing we can do now is we'll summarize it in the recap there. But I think the best thing we can do is give people where they can find out more information on their own if they're looking into your company or you yourself. What's your website, your social media following, LinkedIn?
Yeah. So
Yeah. On our website, blackdiamondam.com. And then, Morningstar is a great resource, looking up our funds and seeing how they're different, and we can set you guys up with some summaries and one pagers. I think you might have them already. So
awesome.
We can do that.
Fantastic. Good. Well,
thanks for having
Eugene,
me, guys.
Appreciate your time. Very nice to see you again.